Are you tired of staring at your bank accounts and wondering if you're using them the right way? Ally Bank is a popular choice for online banking, but what's the real difference between their checking and savings accounts? Let's break it down in under 3 minutes. First, let's talk about the Ally Spending Account, which is their version of a checking account. This is for your day-to-day spending. Think groceries, gas, bills, the money you need to access regularly. The great thing about it is that there are no monthly maintenance fees and no overdraft fees, which is a huge plus. You also get a debit card and can use over 75,000 Allpoint and MoneyPass ATMs for free, with up to $10 in reimbursements for other ATM fees each statement cycle. Another neat feature? Early direct deposit, so you can get your paycheck up to 2 days sooner. Now, onto the Ally High Yield Savings Account. The key here is the high yield part. This is where your money is meant to grow. Instead of being for daily purchases, this account is for your long-term goals, like an emergency fund or a down payment on a house. The main difference is the interest rate. The Ally Savings Account has a much higher annual percentage yield, or APY, than the checking account. It also has no monthly fees and no minimum balance to open, just like the checking account. But there's a catch: it's not meant for frequent transactions. While you can make withdrawals and transfers, they're limited to 10 per statement cycle. So, how do you use them together? Think of it like this: your checking account is your wallet, holding the cash you need for daily life. Your savings account is your vault, where you store the money you're building for the future, letting it grow with that higher interest rate. Ally even offers tools to help you, like buckets to organize your savings goals and surprise savings, which automatically transfers small, safe-to-save amounts from your checking to your savings. With that said, thanks for watching, and until next time.